Good afternoon, everyone. Welcome to Deloitte's Public Sector Accounting Standards Update, Keeping Current. My name is Lynn Pratt, and I'm a partner in our Ottawa office. I'll be your host for today's webcast. A couple of items before I introduce our speakers and our agenda. If you would like a copy of the slides for reference, the slides are available for download on the same webpage as you access this update. Please feel free to direct colleagues to the webcast link by referring them to Deloitte Canada's Centre for Financial Reporting, which is accessible from the IAA Plus website at iasplus.com. Simply select Canada English from drop-down box at the top right of the webpage. I'd like to remind our viewers that our comments on this webcast are our own views and don't constitute official interpretive accounting guidance from Deloitte. Of course, you know, before taking any action on any of these issues, it's always a good idea to check with a qualified advisor. Please note, no professional development certificates will be issued for attending this webcast. We encourage stakeholders to check their provincial institutes regarding potential continuing professional development credits. Now let me introduce our speakers and discuss the agenda. We're joined this afternoon by three speakers who will be facilitating this webcast: Matthew Colley, Cindy Vino, and Shirley Wolf. All of our speakers from across Canada have significant experience with public sector accounting standards. Their contact information is listed on this slide for your reference. Please note that throughout this presentation, we will refer to the Public Sector Accounting Standards Board as PSAB or the Board. We will start our webcast by providing an overview of PSAB activities during the year. We will then discuss new standards that have been issued in 2015, followed by a discussion of current projects that PSAB's been working on. We will then conclude with a discussion of issues raised at the Public Sector Accounting Discussion Group. I'd now like to pass it over to our first speaker, Shirley, who will provide an overview of PSAB activity during the year and will discuss the new related party and inter-entity transaction sections. Over to you, Shirley.
Thank you, Lynn. The Public Sector Accounting Board has several projects underway, with many expected issuance dates in 2016 of either an exposure draft, invitation to comment, or feedback statement. The project that is in the most advanced stage is asset retirement obligations. An exposure draft is expected to be released in the third quarter of 2016. The purpose of the Asset Retirement Obligations project is to develop a standard that addresses the reporting of legal obligations associated with the retirement of long-lived tangible capital assets, currently in productive use. Reporting guidance on this topic was previously included in the pre-changeover accounting standards in Part 5 of the CPA Canada Handbook. The Statement of Principles, which was released in August 2014, included interpretive guidance on the term productive use, which was not included in the Liability for Contaminated Sites standard. This guidance is expected to be useful in applying both standards. An exposure draft was expected to be released in the third quarter of this year for the Revenue project. However, due to the complexity of this project, the Public Sector Accounting Board requires more time to explore the various perspectives and consult. The Revenue Standard is intended to provide recognition principles that apply to revenues of governments and government organizations other than government transfers and tax revenue. Revenues are defined in Section PS 1000 Financial Statement Concepts. Recognition and disclosure of revenues are described in general terms in Section PS 1201 Financial Statement Presentation. This project addresses the recognition, measurement, and presentation of other revenues,
'that' are common in the public sector.
that are common in the public sector. The concepts underlying Financial Performance Project is focusing on the conceptual framework in sections PS 1000, Financial Statement Concepts, and PS 1100, Financial Statement Objectives, from the lens of measuring the financial performance of public sector entities. This review was identified as a high priority in the Public Sector Accounting Board's 2010 to 2013 strategic plan in response to a suggestion from the senior government finance community. This project will consider the concepts underlying the measurement of financial performance. The review may result in amendments to the conceptual framework and could also affect Section PS 1201, Financial Statement Presentation. Since the issuance of the retirement and post-employment benefit standards in the early 2000s, new types of pension plans have been introduced, and there have been changes in the related accounting concepts. An invitation to comment on employment benefits is expected to be released in the third quarter this year. A new comprehensive handbook section is intended to replace the two existing sections. Since the issuance of the Financial Instrument Standard, various issues related to the transition requirements and other matters have been reported to the Public Sector Accounting Board. This project considers the issues as they arise. The Public Sector Accounting Board has also conducted a post-implementation review of the government transfers section of the handbook. This review is intended to help the Public Sector Accounting Board assess the implementation challenges encountered by stakeholders and the nature, extent, and cause of any ongoing issues. Matt Colley will provide us with an update on the progress of this project later in our presentation. At the December 2015 meeting, the Public Sector Accounting Board approved a project proposal to develop an accounting standard on public-private partnerships. The project is expected to develop in two stages. The first stage will involve contemplating specific issues, including project scope, recognition and measurement of a public-private partnership, and disclosure requirements. The second stage will involve determining how to account for public-private partnerships. The website link included at the bottom of the slide can be used to access current information on the status of these projects. During 2015, the Public Sector Accounting Board issued 6 new standards on the topics of related party transactions, restructuring transactions and assets, contingent assets, and contractual rights. The mandatory adoption dates for these standards are for fiscal years beginning on or after April 1st, 2017 or April 1st, 2018, as noted on the slide. Earlier adoption of these standards is permitted. We will be discussing each of these standards in our presentation, beginning with related party disclosure and inter-entity transactions. In March 2015, the Public Sector Accounting Board issued new standards related to the recognition, measurement, and disclosure of related party transactions. Up to this date, the Public Sector Accounting Handbook only included guidance for government entities using the not-for-profit standards included in this handbook. These standards are limited to presentation and disclosure guidance, and many public sector entities refer to other financial reporting frameworks, such as the accounting standards for private entities, for guidance related to the measurement of related party transactions. The Public Sector Accounting Board decided to issue 2 standards, PS 2200, which deals with related party disclosures, and PS 3420, which provides guidance for the recognition and measurement of inter-entity transactions. As a consequence, Section PS 4260, Disclosure of Related Party Transactions by Not-for-Profit Organizations, has been removed from the handbook. The standards are required to be adopted for fiscal years beginning on or after April 1, 2017, on a prospective basis. However, they may be adopted at an earlier date. PS 2200 does not apply to certain types of related party transactions, such as restructuring transactions, which are covered in a separate section of the handbook. For consolidated financial statements, transactions that are eliminated on consolidation, and those with entities accounted for under the modified equity method are also excluded, as well as for key management personnel compensation arrangements, expense allowances, and other similar payments that are routinely paid in exchange for services rendered. PS 2200 provides guidance for identifying a related party, which may be an entity or an individual. From the perspective of the entity that is reporting, parties related to it typically include entities that control it, share control of it, or that it controls, entities that are subject to common control, entities that it shares control of with other commonly controlled entities, entities that are subject to shared control by other commonly controlled entities, entities that it shares control of with other entities, entities that are subject to shared control by other commonly controlled entities and other entities, individuals who are members of key management personnel and close family members of those individuals, entities controlled by or under shared control of a member of key management personnel or a close family member of that individual. Key management personnel are defined as those individuals having authority and responsibility for planning, directing, and controlling the activities of the entity. They may include directors or members of the governing body and senior management of the entity. Two entities may have a member of key management in common. When assessing if these entities are related, consideration needs to be given to the level of influence the individual has over the decision-making process of both entities, and the likelihood that the individual is able to affect the policies of both entities in their mutual dealings. Close family members of key management personnel normally include a spouse and dependents. The identification of key management personnel and their close family members is an area of judgment. This slide includes an example of an organization structure. In this scenario, a government entity controls a government business enterprise, two other government organizations, and shares control of a government business partnership with a third party. Each of the other government organizations has an interest in a partnership. Firstly, let's assume that the government is the reporting entity. The government is related to the government business enterprise and organizations A and B, as the government controls these entities through its ownership of all of the voting shares of these entities. The government is related to the company as it likely controls or shares control of this entity. The government is related to the government business partnership as it shares control of this entity. Further consideration needs to be given to whether the government is related to the third parties. For example, the entities may have key management personnel in common. Secondly, let's assume that organization A is the reporting entity. Organization A is related to the government as it is controlled by the government. Organization A is related to the government business enterprise and Organization B, as these entities are subject to common control by the government. Organization A is also related to the company, as the company is likely either under the control of the government or Organization A shares control of the company with Organization B. Organization A is not related to the government business partnership, as it does not share control of this entity. Further consideration needs to be given to whether Organization A is related to the third parties. For example, the entities may have key management personnel in common. PS 2200 includes a decision tree that is useful in determining whether disclosures are required or not. Disclosures are not required if a related party transaction has occurred at a value that is the same as the value that would have been arrived at by unrelated parties. Further, disclosure is only required if the transaction has a material financial effect. It is important to keep in mind that an exchange of goods or services that has not been recognized for accounting purposes could have a material financial effect on the financial position and results of operations of the reporting entity. Once the transactions requiring disclosure have been identified, the standard requires entities to include in its financial statements information about the nature of the relationship with related parties, the types of related party transactions that have been recognized, amounts of the transactions recognized, classified by financial statement category, the basis of measurement used, the amounts of outstanding balances and their terms and conditions, contractual obligations with related parties separate from other contractual obligations, contingent liabilities involving related parties separate from other contingent liabilities, and the types of related party transactions that have occurred for which no amount has been recognized. Items of a similar nature would be disclosed in aggregate. PS 3420, Inter-Entity Transactions, provides guidance on how to account for and report transactions between public sector entities that are under common control, from both the perspective of the entity providing the asset, liability, goods or services, and the entity that is receiving the asset, liability, goods or services. Inter-entity transactions that involve the transfer of assets or liabilities should be recognized by both the provider and the recipient. Where a central entity exists to conduct activities for controlled entities, there may be a policy of allocating or recovering costs from the other entities. Where a cost allocation policy exists, the provider and recipient should recall all costs and revenues as applicable on a gross basis. Where a policy for allocating costs does not exist, the recipient may choose to recognize costs when two conditions are met. Firstly, they otherwise would have been purchased, and secondly, a reasonable estimate of the amount can be made. When a recipient chooses to recognize unallocated costs, it reports them as revenues and expenses. Disclosures are made in accordance with Section PS 2200, Related Party Disclosures. The standard includes a decision tree that is useful in determining the amount to record. There are three possible bases of measurement for related party transactions. The carrying amount is the amount of an item transferred or costs of services provided as recorded in the accounts of the provider after any required adjustments. Examples of adjustments to consider include amortization, impairment of assets, or changes in the fair value of assets that are measured at fair value. The exchange amount is the amount of the consideration given for the item transferred or services provided as agreed to by the related parties. Fair value is the amount of consideration that would be agreed upon in an arm's length transaction between knowledgeable willing parties who are under no compulsion to act. Generally, the exchange amount is used to record transactions when they are undertaken on terms and conditions similar to those between parties dealing at arm's length. There are, however, a few exceptions to this requirement. If a transaction is carried out for nominal or no consideration, it is measured at the carrying amount by the provider, and the recipient has a choice of either the carrying amount or fair value. Any gains or losses arising from differences between the exchange and carrying amounts is recorded in the statement of operations. Allocated costs and recoveries are measured at the exchange amount. When a recipient entity recognizes unallocated costs, either the carrying amount or fair value is used to record the transactions, unless a policy, budget practices, or accountability structures specify a different basis of measurement. There are a number of areas to consider as you prepare for the adoption of these standards. These include establishing policies and procedures to ensure that related party transactions are appropriately identified, measured, and disclosed. Identifying roles or individuals that would be considered key management personnel. Identifying related party transactions that have occurred for which nominal or no amount has been recognized. Determining a process for assessing whether a related party transaction has occurred on similar terms and conditions as an arm's length transaction. Determining an appropriate materiality level for assessing if a related party transaction has a material financial effect on the financial statements. Determining an appropriate level of detail for disclosures. Factors to be considered include the significance of the transactions, individually or taken as a whole, in terms of size, and whether the transactions were carried out on non-market terms. And lastly, determining an appropriate accounting policy choice by recipients for allocated costs, where no policy exists for allocating costs.
That's great. Thank you so much, Shirley. Before we move on to the next section, I'd like to ask you a question. What are the key differences between PS 2200 related party disclosures and PS 4260 disclosure of related party transactions by not-for-profit organizations in relation to management and members of the immediate family of management?
Thank you, Lynn. The definitions of key management personnel in PS 2200 and management in PS 4260 are very similar. These individuals would have authority and responsibility for planning, directing, and controlling the activities of the reporting entity. The definitions of close family members and members of the immediate family in the respective handbook sections are also similar, and generally include the individual's spouse, dependents, and dependents of the spouse. However, PS 4260 does not identify an entity controlled or under shared control by management as a related party. whereas PS 2200 considers entities that are controlled by or under shared control of a member of key management personnel or a close family member of that individual to be a related party of the reporting entity. Further, under PS 2200, two entities may be related if they have a member or members of key management personnel in common. In this scenario, it would be necessary to assess the level of influence the individual has over the decision-making process of both entities, and the likelihood the individual is able to affect the policies of both entities in determining if the entities are related.
Thanks, Shirley. Cindy will now discuss the new sections on assets, contingent assets, and contractual rights.
Thanks, Lynn, and good afternoon, everyone. So I'm going to start and just provide a quick overview of all three of these sections in terms of why they're there. And really these sections provide guidance for applying the definition of assets that's set out in PS 1000, which is the section on financial statement concepts. They also provide some general disclosure standards. So why did we need them? We actually have some guidance in section 1000 in terms of defining what an asset is. And there are standards in terms of specific types of assets, so for example, tangible capital assets, but we didn't have under public sector accounting standards anything to bridge that. So these standards, I think, would be useful if you are looking in terms of how to account for an asset where there's not a specific standard in PSAB. You could look to these sections to determine how you should account for whatever it is, whatever type of transaction or asset that you're looking to account for. And also these standards will be useful and potentially a little difficult to apply with respect to providing the required disclosure. And that'll be especially true, I think, when we come to talking about contractual rights. The standards are applicable to fiscal years beginning on or after April 1st, 2017. You can early adopt, but for most of you with a March 31st year end, that will be your March 31st, 2018 year. So on this slide, there is a replica of the decision tree that's included in the back of the asset section. And I think it's a useful decision tree because it actually pulls all three sections together. Don't worry about reading it on this slide because we're going to actually pull it apart and go through the different pieces of it as I walk through the guidance that's now included in these three different sections. So the first issue that you need to determine is whether or not there is an economic resource from which future economic benefits are expected to be obtained. So that first question really composes two different concepts. The first being whether or not there's an economic resource. And the standard provides a number of examples, not an inclusive list, but a number of examples that you can look to in terms of thinking about what would be an example of an economic resource. So some of them will be pretty simplistic, and I think we would all take these into consideration in terms of thinking about economic resources. So those would include things like contracts or agreements, so receivable balances, lease receivables, things of that nature. It also, though, could include a government's own legislation. So, for example, a government may have the ability to tax or to impose fines or penalties, and that would be an economic resource on behalf of that government. Could include another government's legislation. So, for example, a provincial government could have a transfer that's receivable from the federal government, and that would be an economic resource. It could be infrastructure. So, for example, bridges, roads, things of that nature, they would be economic resources. And just by way of those examples, you can tell that an economic resource can be financial in nature or non-financial in nature. But an economic resource to be included in one of these standards also has to be able to generate a future economic benefit. And so a future economic benefit means that it will enable a government to provide public goods or services, to redistribute wealth, to generate cash inflows, or to reduce cash outflows. So there definitely are economic resources where economic future benefits are not expected to be obtained. So one of the examples that they provide in the section is the air that we breathe. So the air that we breathe is definitely an economic resource, but there will be no economic benefits obtained from it. So let's take it a step further now and talk about when we get to talking about an asset. So in order to kind of follow down this path of an asset, you first have to answer the question, is there an economic resource from which future economic benefits are expected to be obtained, as a yes. So then if you're in that category, you now have to consider whether you meet the other requirements with respect to the criteria for an asset. So do you control the economic resource as a result of a past transaction or event? And I'm going to talk a little bit more about the criteria that are included in assessing control on the next slide. So let's say you pass that, then you have to consider the guidance in PS 3210, and then you come into looking at, have the recognition criteria been met? And in assessing whether the recognition criteria have been met, you need to assess whether or not there's an appropriate basis of measurement and a reasonable estimate of the amount, and whether recognition is not prohibited by another section. So we know, for example, that accounting for like crown lands and mineral rights is not permitted, as they are intangibles that are not permitted to be recognized in PSAS. So in that scenario, then you wouldn't meet the criteria in terms of recognition, but you would have to disclose information about it. And just one reminder, when we're talking about these are assets for which there isn't another section in the handbook that provides specific guidance. That's when you would use this section. So if we now move on to talk about the concept of control on the next slide, I just wanted to mention a few things that are referred to in the standard, and this is one of the 3 essential characteristics. So I'm in the middle of the slide here. And the first criteria is that, the second criteria, is that the public sector entity can control the economic resource and access to the future economic benefits. So in order to meet that, there's 3 things to think about. One is the government can benefit from the economic resource through its capacity to provide goods or services, to provide future cash inflows, or to reduce future cash outflows. So if any one of those 3 types of transactions can lead to meeting that first criteria. Second, the government can deny or regulate access to those benefits by others. So an example that I was thinking of here is spectrum licenses. So the federal government issues licenses to telcos with respect to the use of spectrum license, and that is something that they are able to regulate. And the third is that the government is exposed to the risks associated with the economic resource. So, all assets almost have an element of risk to them. So if you think of something simple like an investment, then obviously there's an economic risk to that in terms of a decline in value. If you do not meet these characteristics and you do not meet the recognition criteria and you have to disclose information, then you disclose the following, and that is information about the major categories of assets that are not recognized, and when an asset's not recognized because a reasonable estimate of the amount involved can't be made, the reasons for that should be disclosed. So there already is a disclosure requirement in section 1000 related to intangibles that are not recognized, so I think this just provides a bit more detail in terms of the nature of the information that you have to disclose. So we'll move on now to contractual rights. And so in this scenario, we're still saying that there is an economic resource and that there's a future economic benefit that's expected to be obtained. But in this scenario, we're saying that we don't meet the criteria in terms of controlling the economic resource as a result of a past transaction or event. So if we're in the no category there, then the next question we have to ask is, does a contract exist? And a contract is different from legislation or the ability to tax. A contract assumes that there is a counterparty to the transaction. So some of the examples in the standard talk about a lease or a shared cost arrangement. So once we say that we do have a contract, then we also have to assess as to whether or not the contract meets the definition of a contractual right. And we'll talk about that and what is required to be disclosed on the next slide. If you don't meet any of those criteria, then you can see that you go up to the box that says you do nothing. So in terms of contractual rights, there are rights to economic resources arising from contracts or agreements that will result in both an asset and revenue in the future. So I think that's key to the definition to think about when you're trying to determine what your contractual rights are. Characteristics of contractual rights include that they arise out of a contract or an agreement that's binding. There are clear economic consequences, and the contract is enforceable by law. So if you meet those characteristics, then there is a disclosure requirement that is now in place because of this standard, and you have to disclose the description, the nature, the extent, and the timing of contractual rights. So I think this is going to be a fairly significant level of effort in terms of pulling together all of this information. So this might be the sleeper in terms of these three standards, in terms of the amount of effort that it will actually take to apply this. There is a little bit of additional guidance with respect to disclosure in terms of it talks about assessing, what is abnormal, and also thinking about the term of the contract. So I think entities will have to spend a fair bit of time thinking about how they go about this process. And then the final branch of the tree relates to situations where there is uncertainty about the fact that whether there is an economic resource from which future economic benefits will be obtained. So here we're talking about contingent assets. And as you know, we have guidance on contingent liabilities. And so this is really looking at it from the other side. So the first thing to think about is there an existing condition or situation that is unresolved? If there's nothing that's unresolved, there's just uncertainty about it, then you can see you just do nothing. But if there is an existing condition or a situation that is unresolved, then you have to assess whether or not you meet the criteria to disclose information about a contingent asset. So I can think about things like a lawsuit or a dispute with a party with respect to royalties or something like that, where the government or local government or government organization could have an asset potentially depending on the outcome of the specific issue. So once you go down this tree, then if the confirming event is likely to occur, there are disclosure requirements. And we'll look at the next slide in terms of those specific requirements. So on this slide, we've covered most of the top part of the slide in terms of how contingent assets arise, the characteristics of them. The next bullet talks about that you have to assess the likelihood of a future event occurring or not occurring. And that can be likely, unlikely, or not determinable. And of course, that's going to require judgment on the part of management in terms of assessing the likelihood of this confirming event occurring. And that's important because it's only when that future event is likely to occur that you have disclosure requirements. And the disclosure requirements include the following. So the nature of the contingent asset, the extent, unless that can't be measured or disclosure would have an adverse effect on the outcome, the reason for non-disclosure, and when an estimate has been made, the actual basis for that estimate.
Thanks, Cindy. Just a quick question for you. What are some of the issues that management should consider in developing a process to implement this new standard?
So I think the one that's going to take the most amount of time, as I mentioned, is contractual rights. And there's probably an obvious starting point because contractual rights have to be something that will generate revenue and an asset in the future. So one starting point may be to go through your various revenue streams, determine which of those actually come to light by way of having a contract, and then figuring out how you actually are going to capture that data, because oftentimes organizations, they won't necessarily have a system in place that is a contract management system. And so I think this is one to actually get a start on early in terms of thinking how you're actually going to capture the data, and then think about what you're actually going to disclose in terms of your financial statements. I mean, there was quite a discussion in terms of whether the benefit of this disclosure outweighs the cost, and the thought being that the predictive value of this type of information is very beneficial to the users.
That's very insightful, Cindy. Thank you. I'd like to pass it over to Matt now, who will discuss the new restructuring section and also provide us with some details on the current projects that PSAB's been working on.
Thank you very much, Lynn. So in terms of restructuring transactions, there's a new standard that's come out this year. So in March 2015, PSAB issued a new standard on restructuring transactions. And restructuring transactions is a pretty broad topic. And so my overview of the standard today is hopefully going to give everyone a better understanding of what actually constitutes a restructuring transaction and how this new standard could actually impact your organization. So the new standard actually defines a restructuring transaction as a transfer of an integrated set of assets and or liabilities together with related program or operating responsibilities, and where there is no consideration provided or where consideration is not based primarily on the fair value of the individual assets and liabilities that have been transferred. So it's quite a mouthful. It's a pretty broad definition, and so therefore it could really encompass a large number of events or transactions. And a restructuring transaction is actually different from an acquisition, and it's mainly because the consideration in an acquisition would generally be based on the fair value of the assets and the liabilities being transferred. And in a restructuring transaction, it won't be based on the fair value of the assets or liabilities transferred. So in implementing this standard, it will likely be largely event-driven or transaction-driven. So unlike implementing a standard like tangible capital assets or contaminated sites, where there was a significant amount of effort involved in terms of determining the impact on the actual adoption of the standard and setting up ongoing processes, the implementation of this standard would be much more focused on identifying when these events actually occur. And so given the fact that there's usually a significant operational impact from these types of transactions as well, these transactions would typically have a higher profile throughout the organization. So PS 3450 is applicable to restructuring transactions that occur in fiscal years on or after April 1, 2018, although if you want, earlier adoption is permitted. Neither retrospective or prospective application is required for restructuring transactions occurring prior to April 1, 2018 or earlier than that. And that's mainly because the information that's required to adopt the standard on a retrospective or prospective basis, it would just not be available. So if you think about adopting a standard prospectively, that really entails looking at the balances that exist on your balance sheet as of the date of the adoption. And so when you're looking at a restructuring transaction, trying to identify which assets and liabilities result from a previous transaction, that can be quite difficult to handle. And so really the focus is on identifying these transactions on a go-forward basis after your date of implementation. So in terms of the next slide, so when thinking about restructuring transactions, there are two types of entities that are involved, the transferor and the transferee, or the recipient. So the standard covers the accounting for both sides of the transaction. Generally, this standard applies in situations when there is a transaction that meets the definition of a restructuring transaction, and the transferor or the transferee adhere to public sector accounting standards. So for example, if a restructuring transaction occurs between a government and a government business enterprise, and it met the definition of a restructuring transaction, the government would apply this standard because it adheres to public sector accounting standards. But in this scenario, since a government business enterprise would follow IFRS, the government business enterprise would not apply this standard. And so the government would not scope out the transaction in this case just because the GBE didn't apply the standard. Restructuring transactions can be initiated by entities involved, or it could be imposed by a higher level of government through legislation or by the controlling government, and can include transactions such as amalgamations or transfers of programs between entities, or even shared service arrangements. These are just some examples of restructuring transactions, and ultimately the determination of whether a transaction is in the scope of the standard is going to depend on whether the transaction meets the definition of a restructuring transaction. So On the next slide, it's important to distinguish restructuring transactions from other transactions because the nature of the transaction determines how the amount that the individual assets and liabilities received in a transaction should be recognized. So there's guidance in other standards that address similar transactions, such as like acquisitions or and contributed tangible capital assets, and they require that a recipient recognizes the assets and liabilities transferred at their fair value as of the transaction date. In a restructuring transaction, the key point to remember is that the carrying value would prevail, and that would be the amount that would be recorded. An acquisition of a group of assets or an operation or an entity would typically not be a restructuring transaction because the presumption is that consideration under those transactions are based on the fair value of the assets or operations that are being exchanged. So there could be situations where assets and liabilities are transferred in exchange for consideration equaling the carrying amount of the asset. In those circumstances, that would meet the definition of a restructuring transaction because even though there is an exchange of consideration, and it could be significant, the consideration was not actually based on the fair value of the assets and liabilities exchanged. A contribution of an asset can be similar to a restructuring transaction because it could be an exchange of an asset for little or no consideration. So essentially a contribution is really a contribution of an asset is a gift. The key distinction between a contribution of an asset versus a restructuring transaction is that a restructuring transaction, there's a transfer of ongoing operating responsibilities from the transfer. With a contributed asset, that ongoing operating responsibility does not exist or does not get transferred. Finally, restructuring is a term that is sometimes used when there are internal changes within an organization, such as when decisions are made or when there are situations and it's really to discontinue a part of a business or dispose of assets. These situations typically wouldn't meet the definition of a restructuring transaction because they don't result in a transfer of assets and liabilities along with the ongoing operating responsibilities. So for example, if a hospital determines that it can no longer provide efficient and effective emergency room services to the surrounding community and it decides to close its emergency room, that wouldn't be considered a restructuring transaction, even though the hospital may decide to internally reallocate its resources. However, if the hospital were to enter into an agreement with another hospital and transfer over the emergency department assets and liabilities and the services to a neighboring hospital, this could constitute a restructuring transaction because there has been a transfer of assets and liabilities and ongoing responsibilities. So when looking at how to implement the standard, the most important step is to have a strong understanding of the definition of a restructuring transaction. The risk in applying the standard is really in understanding when a transaction would be caught under the standard. So if there's one key takeaway from my part of the presentation today, it's to understand what the definition of a restructuring transaction is. And essentially it has three characteristics. One, there has to be a transfer of an integrated set of assets and liabilities that are not random or unrelated. Two, the transfer, program, or operating responsibilities related to the assets must be transferred. And three, they have a non-purchase nature. So consideration is not based on the fair value of the assets and liabilities transferred. So once you've determined that a transaction is in scope, entities could then look at the recognition, measurement, and disclosure requirements in the standard. The first step is to determine whether the assets and liabilities that are being transferred meet the recognition criteria under PSAS. For a transferor, they would contemplate whether it would be appropriate to derecognize the asset from their books as well. So in determining derecognizing assets and liabilities, the transfer would do so at the carrying amount of the item. A transferee or a recipient would consider in recognizing the asset whether adjustments are needed to be made to the carrying amounts of those assets in order to comply with the transferee's accounting policies or in order to comply with public sector accounting standards or to appropriately reflect the circumstances of the recipient. The overall net increase or decrease in net assets would be reflected as a revenue or an expense in the statement of operations in the year that the transaction takes place. When carrying out a restructuring transaction, there could be additional costs that would be related to the restructuring, such as for professional advisors. Those lawyers and accountants sure need to be paid. those types of costs, which are characterized as being paid to third party, they're considered to be outside of the entities that are carrying on the restructuring. So therefore, they should be accounted in accordance with the applicable accounting standards that would normally be followed for those types of costs. And finally, when disclosing restructuring transactions, there's going to be some judgment involved. But the main general requirement is that, disclosure requirement is to ensure that there is sufficient information to enable users to assess the nature and financial effects of a restructuring transaction. So restructuring transactions can be difficult to identify. So, one example that we have here on the slide is where two hospitals could merge or amalgamate and form a single entity. More commonly in government, there could be programs that are transferred between departments or ministries that would have an impact on their standalone financial statements for those ministries. And programs could also be downloaded or uploaded as well from one level of government to another. More often than not, programs are likely to be downloaded rather than uploaded, but either situation could result in a restructuring transaction. As well, even entering into a shared service arrangement could result in a restructuring transaction as well. And so while this is a standard that may not have a big transition impact, understanding the standard and identifying restructuring transactions when they do occur will be the challenge when implementing this standard. Okay, so now looking ahead, so we've covered the standards that have been developed over the past year that have been issued by the Public Sector Accounting Board. But as you can see, as you can tell, the Public Sector Accounting Board has been very busy, not just in terms of developing these standards, but also working on projects. So the next part of our webcast is going to focus on the possibilities around future developments of public sector accountings and discuss some of the challenging issues that lay ahead. And so as Shirley mentioned, the first item I want to talk about is the exposure draft on revenue. And so public sector accounting standards have some good guidance on some specific types of revenue transactions that are certainly unique to the public sector. So there's guidance on taxation revenue and government transfers specifically. But in today's world, there are many types of revenue streams that wouldn't fit into existing standards, or these standards. So there was a need to create a new standard to cover more types of revenue transactions that can occur in the public sector. In many situations, if you have a revenue transaction that is a non-government transfer, not a tax revenue, you'd look to Section 1000 and rely on first principles to determine the accounting treatment. And you'd also look to the financial statement presentation standard to look at the recognition criteria and disclosure requirements. In terms of status, of this project, there was a statement of principles that was issued in August 2013, and responses were received in February 2014. So it's almost been about 2 years where there's been deliberations on the comments received from the SOP. And so that really indicates that there certainly were some good comments received on the SOP, and certainly, this is going to be a standard that is going to be, I think, challenging and complex in terms of some of the issues that are going to arise. PSAS was targeting an issuance of an exposure draft for Q3 for 2016. However, the most recent update by PSAB has shied away from actually defining a timeline for the release of an exposure draft on this project. So at a high level, the SOP identifies that there can be revenues that are considered exchange revenue, which means that there are revenues that are clearly associated with the promise of goods or services. So in an exchange transaction, there would be performance obligations that would have to be met. And so revenue recognition, as proposed in the SOP, would occur as each performance obligation is satisfied. So for example, I take my kids to swimming lessons, which is run through my local municipality. And so I pay an upfront fee for those swimming lessons. But if this, I could actually be refunded in situations where the pool is actually closed, right? And so it does actually happen from time to time, given the age of my children for various reasons. But so one could conclude in this situation that each swimming lesson would be considered to be an individual performance obligation for the municipality. And so therefore recognition of revenue would occur as each class occurs, rather than when I've actually paid the cash and received it, and they've received it up front. And so the example I've given may not be material to my local municipality, but it certainly gives you an understanding as to some of the issues that could result from the standard. So the other type of revenue transaction that's discussed in the SOP is the concept of unilateral revenue, which is really unique to the public sector, and it's revenue that is not associated with a specific public service or benefit. So there are no performance obligations with these revenues, and typically they are recognized when there is an authority to charge the revenue and an event has occurred that establishes the right to the revenue. So, for example, a situation where I might get a speeding ticket. The event, when the event occurs, it's when the police officer catches me speeding, and so at that point, that would be when that event has occurred, and the revenue would be recognized. There's no ongoing performance obligation or anything like that from the municipality's perspective. So in terms of that's just the difference between a unilateral revenue and an exchange revenue. So moving on, in terms of the next exposure draft I want to talk about is asset retirement obligations. And so if you attended our webcast last year, you would have noted that we spoke at some length in terms of the statement of principles that was out on the asset retirement obligations. And so I just want to give a quick refresher or update on this project as well. So PSAS is in the process of deliberating comments that were provided as part of the statement of principles, and there's expected to be an exposure draft in Q3 of 2016. So the good news about asset retirement obligations is that entities should be able to leverage some of their work around contaminated sites to implement the asset retirement obligation standard when it does come to fruition. Implementing contaminated sites required entities to look at all of their sites and determine whether there were obligations that should be recorded for remediation activities. Sites that were in productive use were excluded from the contaminated site standard, and so the scoping exercise that the entities undertook to identify contaminated sites would likely point entities in the direction of areas where asset retirement obligations exist. Asset retirement obligations are liabilities that exist or are associated with the retirement of a tangible capital asset. And so the obligation could arise as a result of developing an asset, or when you acquire it, or even when you use it. So like a contaminated site, an asset retirement obligation is a liability, but the key difference would be on the debit side of the transaction, as it would be capitalized to the tangible capital asset rather than expensed on the statement of operations. So as I mentioned, the implementation of an asset retirement obligation standard should hopefully build off of the work that most entities have done on contaminated sites. And so just moving on, in terms of the next item I want to talk about is the post-implementation review of government transfers. And so PSAB and other standard setters in Canada are now undertaking the practice of conducting a post-implementation review, which examines how entities implemented the standards that they developed, or the standards that have been developed by the Accounting Standards Board. So this is a best practice in the standard setting world, and PSAB is conducting an open process that has allowed stakeholders to provide feedback to PSAB. The intention of a post-implementation review is not to provide an opportunity to open up and revisit the standard, although that may be a side effect. The point of a post-implementation review is to help the standard setter understand the implementation challenges, which will ideally impact how a standard setter develops future standards. So government transfers is one that's been it's been a controversial standard right from the beginning. I think it took around 10 years to actually develop the standard, and the implementation of the standard was a challenge for many entities. In my view, there were different interpretations on how you could apply certain paragraphs of the standard. I think some of the paragraphs that were in there people liked, but they just couldn't really figure out how to apply them. And so the major issue that the post-implementation review has focused on is to date has been how you would recognize revenue from a capital transfer. So with a capital transfer, one view is that these transfers would have stipulations that would be met once an asset has been purchased or constructed. And so meaning that the transfer would be recognized in revenue once the asset's been fully recognized on the balance sheet. The downside to that is that this would cause a mismatch in your statement of operations, because you'd be having revenue being recognized and there'd be no corresponding expense. The opposing view, or the alternate view, is that capital transfers have an implicit or sometimes even more explicit stipulations that really state that the asset is that's being funded must be used by the organization over its useful life. And so essentially this view argues that the stipulation is met over the life of the asset, and so revenue would be recognized over the life of the asset. So this view results in a P&L where revenues and expenses would be equal, but you'd also have a liability on your balance sheet for a capital transfer. And the issue with that really is that some people have a hard time accepting whether or not that liability actually meets the definition of a liability. So while recognition of capital transfers is the big issue, there are other issues that exist with this standard as well. One issue, for instance, is how an appropriation process, how that interacts with the authorization requirement or the criteria that's required by the standard. Another situation is where transfers are provided over multiple years as well. So while this is the first post-implementation review by PSAB, given the issues that we have seen in the implementation of the standard, this will be a very important feedback statement. And so it's something that you should watch out for in early Q2. So, and just in terms of the next steps, so responses were received in May 2015, and PSAB has moved quickly in working back and getting back on a feedback statement. And so in terms of timing, PSAB is targeting to issue the feedback statement in Q2 of 2016. And so the last item I just want to talk about quickly is just the feedback on the adoption of liabilities for contaminated sites, so PS 3260. And so, the implementation of the standard has gone smoothly for some organization, and it has caused angst in other organizations. And so we just wanted to provide a summary of feedback that has been given publicly and that's been discussed in open discussion groups, and as well from our own experience in helping clients implement the standard. So from our observations, the organizations that were most successful were those that were engaged, that engaged the appropriate parts of their organization to help with the implementation of the standard. So it's really, the standard could not be implemented by the accountants alone, and so it really relied on the entire knowledge of the organization to implement the standard. So probably one of the most important things to consider when looking back on how entities implemented, PS 3260 was really on how they looked at the development of a sustainable reporting process for contaminated sites. So if you think back to the process that your organization undertook this year to implement the standard, you quickly realize that it's not one that you want to repeat. So this means that organizations should be considering what processes and controls and even systems should be in place to effectively capture the necessary information to report on its liabilities for contaminated sites. A lot of organizations have seen a lot of value of implementing this standard because it's touched upon understanding the risks that are involved with environmental liabilities and requiring organizations to consider how they are planning on addressing these issues. So the controls and processes that are being put in place can go much beyond the financial reporting aspect and really sort of look at how organizations approach the risk in addressing some of these environmental issues. And so that's really all I wanted to cover off of that today. There's a number of other items on there as well that I think are relatively self-explanatory.
That's a great update, Matt. Thank you. Before we move on to the next section, though, I'd like to ask you a question. For government transfers of capital assets, you mentioned that there were some inconsistencies in how governments applied the standard. Can you provide an idea, please, as to which governments concluded that a stipulation would be met through a purchase or acquisition versus governments that concluded a stipulation could be met through the consumption of an asset?
Thanks, Lynn. So in terms of that, there were two provincial governments in particular that sort of looked at government transfers and did think that you did have a liability for a government transfer for a capital asset over the life of the asset. So there was some ongoing requirement to actually use the asset. That was in particular the government of Ontario and the government of Alberta. But the thing to note there too is that in Ontario in particular, there a lot of the entities that ended up having government transfers, they also were following the not-for-profit standards, the PS 4200 series, and so they weren't actually following the government transfer standard. In terms of the other provinces, there's certainly, I don't know specifically every single province, but there certainly were some tricky transfers there as well, and I think a lot of people did struggle with that as well. But for the most part, I think the overall view was that people really saw that there was an obligation up until an asset was purchased or constructed, and then after that, there wasn't necessarily an obligation for a capital transaction beyond that. But it does depend on the specific facts and circumstances of the transfer.
For sure, the devil's in the details in all of those contracts.
Yeah.
Cindy, do you mind finishing off the discussion on the remaining PSAP projects for us, please?
Sure, Lynn. So I'm going to next take you through a little bit of an update on the conceptual framework, so consultation and the consultation paper 3 that was issued. So in this slide, you can see that the task force, and I've actually had the privilege of being a member of this task force, has been hard at work for the last 5 years and has issued 3 consultation papers, the last of which was issued in March of 2015, and comments were due in August. There were, I think, almost 40 comment letters submitted on consultation paper 3, and that added up to almost 700 pages of comments, and they're all posted on the PSAB FRAS Canada website, and so you can definitely access those and take a read through. In terms of the key proposals that are part of consultation paper 3, they are listed here on this slide in a series of circles, and the circle in the middle is the focus on accountability. And so if we just step back and say, well, what is a conceptual framework? And it's supposed to be a coherent set of interrelated concepts that underlie accounting and financial reporting standards. So it's really the foundation on which standards are developed and professional judgments applied. And in a recent article that the chair of the task force wrote, he kind of used the analogy of building a house. So the conceptual framework is like the foundation, and then all the standards actually represent the balance of the house once it's built to create this nice house of accounting standards. And the reason that there is the circle in the middle, which is a little bit bigger, and it says focus on accountability, is because the work of the committee has really focused on accountability as being key to developing a conceptual framework. And that's because public sector entities are granted certain powers and rights and responsibilities in order to fulfill their provision of public goods and services to the public. And that means that there is such a strong underlying focus on accountability because government is using resources that belong to all the citizens in terms of redistributing wealth and in terms of providing goods and services to the public. So if we just take a quick zip around this circle, I'm going to talk about some of these key proposals in more detail, but I'll just touch on them starting at the top of the page. So tighten budget to actual comparison rules. So the proposal speaks to conceptual paper 3 or consultation paper 3 speaks to the thought of having more detailed guidance around how and what should be disclosed with respect to budget to actual comparisons. And that really builds off the focus on accountability. So what is a government organization accountable for? And what was proposed were some additional considerations in terms of what you would be able to disclose if you were if you had prepared your budget on a different basis, either in terms of the accounting standards that were followed or even the entity for which you prepared a budget. And obviously a budget document is a policy document, so PSAB and the accounting standards do not provide guidance in terms of how a budget should be set, but it does, the conceptual framework, and this consultation paper 3 did focus on how the accountability objective would be best met in terms of budget to actual comparisons. A service capacity model I'll touch on separately. The paper does focus on retaining an asset and liability model, and that has some implications that I'll talk about in terms of the new reporting model. There were some improvements made to the element definitions. In terms of the measurement requirement, the consultation paper 3 speaks to historical cost as being the basis, but acknowledging that other measurement bases may be more appropriate. And I'll take us through the new reporting model that is proposed. So the next concept I said I would talk through in a little bit more detail is this concept of service capacity and a service capacity model. And so one of the items that the task force has spent quite a bit of time talking about is what should be measured in terms of financial performance for a public sector organization, because public sector organizations are not meant to generate and measure profit. So what should we be measuring? And because public sector entities exist to serve the public by providing public goods and services, it seems that measuring their ability to provide that service is going to be paramount. So that concept is more thoroughly explained in consultation paper 3. And what is on this slide is simply acknowledgement that when you look at a statement of operations and you look at the difference between revenue and expense, that line represents the change in service capacity. And so it's really the consultation paper was focused around trying to solicit feedback in terms of, is that the right thing that should be measured? Service capacity itself is measured based on, the difference between assets and liabilities, and then obviously that can increase or decrease each period. And it's not that an increase in service capacity is always a good thing, because perhaps you didn't provide the services that you meant to provide. And it's not necessarily that a decrease is a bad thing either. So there was a lot of feedback that was provided, and there's, I think, more work to be done in terms of exploring in more detail this concept of a service capacity model and how it is dealt with in terms of a new conceptual framework. The next point that I wanted to touch on is just the whole reporting model. And so this next slide speaks to what our current model is and what our proposed model is under the consultation paper. So the current model, as you can see on the left-hand side of the slide, sets out the different financial statements that are currently required. So statement of financial position, operations, remeasurement gains and losses, change in net debt, and cash flow. And the proposed reporting model keeps many of those the same, but eliminates 2 separate statements of operations and remeasurement gains and losses, and proposes one single statement referred to as a comprehensive statement of comprehensive financial results. And part of that was to respond to the thought that, for a conceptual framework and for a set of standards to be useful, they need to be understandable to the users, and reducing the number of standards versus increasing the number of standards would be helpful in terms of improving understandability. And this next slide is a very simplistic example of a statement of comprehensive financial results. So it starts out as you would, I think, expect, with operating revenues and operating expenses. And that comes to a net result, which for this purpose has been termed the net result of services or programs. And then below that are some other items. And there are 3 items in there: the transfer of acquisitions for tangible capital assets, unusual items, and unrealized remeasurement gains and losses. And if you think about these on a combined basis, these are items where potentially a government organization would be unable to budget for. So unusual items could be things like natural disasters or something like that. Unrealized remeasurement gains could come from financial instruments that an organization is reporting at fair value and not intending to sell anytime soon, but there are periodic gains and losses which will reverse over time, so they may not be able to budget those either. And then transfers for the acquisition of tangible capital assets. Matt talked about the fact that in terms of government transfers, there are a couple of different ways that the standard is being applied. And not to say that the standard doesn't provide for that, but there seem to be some sort of clear views in terms of how that standard should be applied. And so this presentation proposed solution was really saying, you know, if a transfer comes in for the acquisition of a capital asset and it's recognized in full at the time that the asset is acquired, that's an amount that would be reported below the net result of services and programs. If the view is that the transfer for the tangible capital asset should be recorded as the related depreciation is recognized, that would actually go up in operating revenues. So as you can imagine, this is actually quite a change, and again, you can read the comments on the website, and there were a number of comments that responded to this. So the work of the committee will be to assess those comments over the next several months. And so just in terms of that process, as I said, the deliberation will continue to occur in 2016. The next step in the process is to issue a statement of principles, but as of the current time, there actually is no set timeline for that. I'm going to spend just a couple of minutes on financial instruments. So during our webcast last year, we had talked about the exposure draft that had been issued by PSAB in October 2014, and comments were due on that in October 2015. But what actually happened is during the comment process, a number of additional issues were raised. And so in June of 2015, PSAB actually decided to extend the effective date of the standard for governments that had not yet applied, or government organizations that had not yet applied the standard, to April 1st, 2019. So there are a group of government organizations out there that certainly have already adopted the standard, but for those that haven't, it's now been pushed out for another few years. And one of, I guess, the two areas that are being focused on in terms of looking at the standard are issues related to foreign currency hedging and financial instruments, specifically raised by senior governments. So I would say just stay tuned in terms of the next steps with respect to the financial instrument and actually the foreign currency standard. The next standard I'll talk about, and it's not yet a standard, but a project, is on employee benefits. So this is a project that's just getting started. And Shirley had mentioned at the beginning of the webcast that the project is really to look at the current standards that are in place. And the first stage will be to look at issues such as, deferral of experience gains and losses, discount rates, multi-employer defined benefit plans, and really take a look at whether or not these the guidance in these standards is still the most appropriate. And as you may know, different standard setters, so IFRS, US GAAP, have moved away from the either having experience gains and losses netted on the balance sheet, or actually deferring them and recognizing them over time. So PSAB determined that it was time to take a look at this. And then the second stage is to actually look at how to account for new types of pension plans. So, the standard talks about two different types of plans, being defined benefit and defined contribution, but actually some of the new plans it's a lot less clear that they actually fit into one or other of those buckets. And so the question is, how should those plans be accounted for? The task force for this project has already been formed, and it's expected that an invitation to comment will be approved in Q3 of this year. And the last standard that I'm going to speak to, or the last project actually that I'm going to speak to, is the Joint Not-for-Profit Review. So back in 2013, the Accounting Standards Board, who sets standards that include private not-for-profit organizations, and PSAB, worked together and issued a statement of principles. And that statement of principles garnered a lot of attention. I think there were close to 300 responses that came in. And so since that time, the boards have been considering what they are going to do with those responses. And the Accounting Standards Board has reaffirmed its commitment to continue. And what they've talked about is, maintaining a separate set of standards for not-for-profits in the private sector, to use the improvements process to review the standards in Part 3 of the handbook and update them where necessary, and to work collaboratively with PSAB in terms of achieving consistency between private and public standards for not-for-profit organizations. The Accounting Standards Board has actually created a not-for-profit organizations advisory committee, and they actually met for the first time earlier this week. So that process from an Accounting Standards Board perspective is well underway. The PSAB's direction is actually not as clear right now, and there has been no committee formed. And just a reminder that this, where PSAB goes will affect those entities that are following the 44 series of standards as opposed to following what we refer to as full PSAB. So if you are following the Accounting Standards Board plan with respect to private not-for-profit organizations, and this would impact entities like hospital foundations, for example, or universities in Ontario. So there are entities that are closely related to public sector entities that would be following these standards. There are 3 phases that the Accounting Standards Board intends to address these issues in. The first one relates to issues that, in my view, were not that controversial in terms of the statement of principles. So capital asset issues, collections of works of art and historical treasures, and disclosure of related party transactions. The second phase is a bit more controversial in terms of how a not-for-profit organization reports other entities that it controls. And then the last bucket relates to how do you account for contribution revenue. And this relates to that whole issue that Matt and I have both referred to in terms of accounting for transfers that relate to the acquisition or use of capital assets. And so, yeah, just stay tuned on this in terms of where this one goes, especially if you're dealing with private NPOs.
Cindy, just a quick question in regards to the joint not-for-profit review. Do you have any insight into what PSAB is going to do regarding the 4400 series?
I think what we've heard generally is that the long-term view is to remove the 4400 series and have government not-for-profit organizations follow PSAB in general. And I think you saw a little bit of that in terms of Shirley's presentation on the related party transactions, where the specific standard that was included in the 4400 series has been removed because there now is a general related party transaction and inter-entity transaction standard in place. So I suspect that we'll see them continue to move in that direction, but in terms of how quickly that will happen, I think that's probably pretty hard to determine at this point.
Thanks, Cindy. Our final speaker, Matt, will end with a summary of topics discussed by the Public Sector Accounting Discussion Group over the past year. Matt, bring us home with this last topic.
Sure, thanks, Lynn. So the Public Sector Discussion Group is really a group of passionate accountants that come together on a semi-annual basis to discuss application issues of public sector accounting standards. So to steal a term from the Toronto Maple Leafs, it's a passion that unites us all. So the group is a discussion forum only. So that means that individuals who participate, they're really there to provide their thoughts, but that discussion is non-authoritative. It doesn't represent the views of their organizations or of PSAB in general. And so the results of the discussion are shared with PSAB. They do oversee sort of the results and the planning for the discussion. And when necessary, PSAB does consider the discussion as part of their standard setting activities. So on the next slide, 2015, in 2015, there were many topics that were discussed. And so I'm only going to just talk about a couple of them now. So the first item, presentation of budget information, that was one that happened early in 2015. And so PS 1201 requires that financial statements with a statement of operations, have a statement of operations that compares results with those that are originally planned. And so the discussion paper here really focused on what is meant by originally planned. And so the paper walks through a number of scenarios, such as what do you do when an election occurs and a new government is formed and they create a new budget? Or what happens if a government-controlled organization is required to change its budget because there's been an election and the controlling government has requested a change because of that? And so in those situations, it really ended up where there were a lot of mixed views. where an election did occur. But one situation that really seemed to have a clear response there that was discussed was when there's a new program that wasn't in the original budget, wasn't planned, and the government or a government organization had to take that on during the year or develop that. And the general consensus there was that, if there's a new program, an event that happens during the year that just wasn't contemplated in the initial budget, really, you don't end up changing your originally planned budget. That was sort of frowned upon, and really you could use the notes of the financial statement as a useful avenue in explaining changes that were needed from the statement of operations and the budget impact. So on the next slide, I just want to talk about one item there, and it's the second item relating to the acquisition and development of software associated with cloud computing. And so the reason why I want to highlight that is because it is sort of an up-and-coming issue. So cloud computing is becoming a new method of delivering software across all types of industries. And so there was a discussion that the public sector discussion group had, but there was also a discussion that the IFRS discussion group had as well on this topic during the year. And so with cloud computing costs, there can be some significant costs associated with setting up cloud computing. And so the discussion really focused around what types of costs would meet the definition of a capital asset under PS 3150. So as you know, software under PS 3150 is sort of seen as the acceptable intangible that is sort of scoped in with PS 3150, and so you could capitalize software. And so when we're talking about cloud computing, I mean, sometimes it's referred to as software as a service as well. The question really is it software? And there's lots of different types of costs that are involved. And so, in all the various types of arrangements that can exist, could you get to situations where you're capitalizing it, or are these more likely items that you would have to expense? And so generally the result of the discussion was mixed, and it was noted that these arrangements are not all alike. There's lots of differences. And so while nothing formal was actually decided, there was discussion that there may be the development of a public sector guideline down the road that would be seen as sort of supplementing PS 3150 and would hopefully help entities deal with the accounting changes in emerging technologies that are occurring out there. So that's just just two sort of topics that I wanted to highlight today, but there are many more topics, and they are available on the Public Sector Accounting Board website as well. So if you want to look at them, you can certainly take a look.
Thanks, Matt. Can you describe the process as to how one could submit an issue to the public sector discussion group and how to observe the meetings?
Sure. So there is a process online in terms of you can email them and you can write a paper and submit that to them, and they will take a look at it. And there is some criteria that they look at when looking at an issue. So they do want to look in terms of broad applicability across a number of entities, and they really sort of look at it in terms of, is it something they're looking for examples where they might see inconsistencies in the sector as well. But ideally, the way it sort of works, they do look for submissions from a variety of people, preparers, stakeholders, users of financial statements, auditors as well. So you can submit electronically, but please also feel free to reach out to your professional service provider. You can reach out to myself, Shirley, Lynn, Cindy as well. We'd be happy to help in terms of getting issues across to the public sector discussion group as well. And in terms of observing the meetings, right now you can only observe the meetings in person in Toronto. But there is hope that there will be technology available where people will be able to dial in, but they're not quite at that stage yet. And so certainly it is a little bit difficult, but they do post the results of these meetings online as well. So you do get to see sort of the results a couple of weeks after the meetings have occurred.
Great to know. Thank you very much, Matt. This brings us to the end of our webcast. Thank you again to our speakers, Matthew Colley, Cindy Vino, and Shirley Wolf. We hope you found this webcast helpful and informative. If you have any questions or feedback, you may also contact any of the speakers or your Deloitte partner or Deloitte contact. Also, if you'd like additional information, please visit our website at www.deloitte.ca. And to all of you viewing our webcast today, thank you for joining us. This concludes our Public Sector Accounting Standards Update, Keeping Current webcast.